Hi guys. Today we will analyze Oracle stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market. Also recent evolutions are not positive. The short-term trend is negative, while the long-term trend is still neutral. Strong support levels are around $67 and $61. Next strong support levels are around $56 and $51. Strong resistance levels are around $73 and $83. Next strong resistance levels are around $90 and $99. In the last month the stock has been trading between $63.80 and $74.80 range. It is currently trading in the middle of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 7.8 million. This is a good sign as it is always nice to have a liquid stock. The stock has been in a downward trend since October 2021. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 2% per year, for last 5 years. We see that the average profit margin of the stock has been around 23% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 155% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Oracle Company: bad, average, and good. First scenario. Oracle will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low, 2%. Future profit margin would be a low, 22%. Future free cash flow to net income rate would be a low, 80%. In this case, the fair value of the stock today would be $45. Second scenario. Oracle will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 3%. Future profit margin would be average, 23%. Future free cash flow to net income rate would be average, 90%. In this case, the fair value of the stock today would be $54. Third scenario. Oracle will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 4%. Future profit margin would be high, 24%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $65. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 2.66. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Oracle, analysts forecast growth rate around 6% per year in next 5 years, and future P/E around 15. Again, I will use 3 different scenarios for Oracle Company: bad, average, and good. First scenario. Oracle will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be a low, 2%. Future P/E would be a low, 16. In this case, the fair value of the stock today would be $22. Second scenario. Oracle will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 3%. Future PE would be average, 19. In this case, the fair value of the stock today would be $28. Third scenario. Oracle will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 4%. Future PE would be high, 22. In this case, the fair value of the stock today would be $35. As you can see, today the stock is overvalued, $70, even if we expect the company's high performance in future. While the company has a good profitability rating, there are some concerns on its financial health. Also, the stock is expected to show a small growth in revenue in the next 5 years, 4 to 6% yearly. Based on that, the stock looks overpriced at the moment. The stock has been in a downward trend since October 2021, and it can go lower before it recovers. I may consider buying the stock when the stock drops to $50. Company strengths. Oracle Corporation is an American multinational computer technology corporation. Oracle is the third largest software company globally by revenue and market capitalization. They are the world's most popular database provider. Its software products include database, middleware, application and cloud-based software, designed for general business purposes and for specific industries. About 48% of revenue comes from overseas. In addition, Oracle provides product upgrades, maintenance releases, and patches through license update agreements, as well as extensive product support. Oracle also provides server hardware through its acquisition of Sun Microsystems in 2010. Oracle's relational database should be able to post strong growth, as customers continue to depend on its quality features, such as data partitioning, which brings in comparable load balancing efficiency. Oracle's stake in TikTok Global, and cloud services to TikTok's U.S. operations, should add a significant boost to Oracle's top line and attract more general-use cloud customers. Management expects accelerating revenue in 2022, as the fast-growing cloud business becomes a larger proportion of total revenue. Oracle's return on assets of 7% and profit margin of 18% are amongst the best returns of the industry. Risks. Oracle shares have suffered due to both general tech sell-off, and more specifically following the company's large acquisition offer for Cerner. Cerner Corporation is an American supplier of health information technology services, devices and hardware. Investors continue to be nervous about Oracle's $28 billion takeover of Cerner. Oracle expects to ride the secular wave of enterprise cloud digitization. The critical question is whether Oracle can defend its market share, by incentivizing its already large installed base of enterprise database customers to move workloads to the Oracle Cloud, instead of to one of its hyperscale cloud competitors. These include industry leaders Amazon Web Services, Microsoft Azure, and Google Cloud. As the company shifts from being an on-premise provider to a cloud service provider, the initial shift may diminish revenue growth, as cloud services cannibalize on-premise sales. The company also faces ongoing operating risks in its core businesses, including the possibility of unexpectedly weak demand due to the COVID-19 pandemic, and risks related to the integration of acquisitions. Oracle has negative shareholder equity, which is a more serious situation than its high debt level. Based on estimates for the next 5 years, Oracle will show a small growth in revenue. The revenue will grow by 4 to 6% on average per year. The earnings per share is expected to grow by 8% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.